Okay, so in this video I'm going to talk a little bit about shareholders equity, talk a little bit about the dividends, both cash dividends, dividends to common stockholders or to preferred shareholders, and we'll talk a little bit about stock dividends. I don't know if I just mentioned that. And a couple other subject matters that relate and pertain to shareholders equity. Okay, and we'll go through a lot of the transactions that journalizing of a lot of the transactions that occur which involve shareholders equity. Okay, so I probably should have started with this box because this is just a summary of what a shareholders equity section would look like. At least this one, this is what goes below the liabilities in a balance sheet. And this is just a sample that I have here that I just created. So you can see we have preferred stock in this company, common stock, paid in capital in excess of par for preferred, paid in capital in excess of par for common, which gives us a total paid in capital of $411 million, and then retained earnings of $210 million for $621. So if you don't understand any of this, don't worry about it, because that's what we're going to explain. That's what I'm going to explain during this video. And so you'll have a better idea of how all this comes about and what it represents. So let me just start by talking a little bit about what equity represents. And at this point you probably have an idea, but let me just review. Well, equity are funds that corporations receive to fund their operations. The difference between equity and creditors is that when you are an equity holder, you own a small percentage of the company, right? So if you own stocks in Apple, you could go around telling people that you're a partial owner of Apple Corporation, right? You probably will own maybe 1/1,000,000th of a percent of it, if not less. But every time you own a stock, you're owning a part of a corporation. So you're buying a piece of that corporation. And that corporation is broken down into millions of pieces, which we call shares. And those shares are sold so that the companies can bring in funds so that they can continue expanding their operations, right? So if you have a company that's worth $10 million and let's say you're greedy and you don't want to share it with anybody, well, it might stay at $10 million. But let's say if you could bring funds in and instead of being 100% owner of $10 million, you could be 25% owner of a $1 billion company, because with the funds that you bring in, you can create a $1 billion company, right? So you would rather go out there and sell shares in your company. So you would sell 75% of your company in shares. You'll keep 25% of those shares for yourself, which represents your portion. And so that 75% will bring in thousands, millions of dollars for you to fund your operations and grow the company. And so now you will no longer own 100% of the company, but the company will be far more valuable, right? Now it's a bigger company, more valuable, and your smaller percentage is going to be worth more than if you owned 100% of the company without that equity funding. So that's the idea behind equity funding, and why most entrepreneurs and investors, which are sole owners, go ahead and enter the equity markets and make their companies public, to bring in funds and to expand their companies in a way in which they couldn't expand without those funds. Okay, so let's explain very quickly these three concepts. So when a company does shares, it has a certain amount of shares that are authorized. That's the maximum that the shares that the company can sell. Who gives authorization? Well, it's probably a state. It's given through the company's articles of incorporation, and it's determined by certain state laws and so forth and so on. But it's suffice to say that authorized shares is the total amount of shares that the company can sell. Issue shares are the number of shares from the authorized shares that the company has issued. So if the company has authorization to sell 10 million shares and it actually sells 8 million shares, then it has 8 million issued. Now here there could be some confusion. So what's the difference between issued and outstanding? Well, sometimes companies purchase stock back and they hold it in their treasury stock. Why do they hold this stock? Well, a lot of their managers get paid incentive compensation, and they may get paid through stock. So the company will purchase some shares back and hold them in sort of an account. So in a sense, these shares are outstanding, but they're owned by the company. So they're not really, they're not going to be counted as outstanding. I should say these shares are issued, but they're owned by the company, so they're not going to be counted as issued. Okay, at least they're not going to be counted on the outstanding section, I should say. So let's say in the same example, I have 10 million authorized. I issued 8 million as a corporation, so I have 8 million issued. 5 years down the line, I decide to buy back 2 million and put it in my treasury shares because I'm going to use those stocks to give for incentive compensation to my management. So I will have 6 million shares outstanding. 8 million issued, 6 million outstanding, and 10 million authorized. Okay, so that's the difference between these three terminologies. There are two basic types of stock. So let's go to this third box here, and then we'll start doing transactions. There are two basic types of stock. You have the preferred stock and the common stock. Okay, preferred stock is sort of like a hybrid between a common stock and a bond, in the sense that it pays a fixed amount of dividends. So you can say that my preferred stock has a par value of $100 and it will pay 4%, okay, or $4. It could be expressed in percentage or in dollar amount. So what does that mean? Well, that means that the preferred stockholder has the right, before any common stockholders, to get $4 in dividends before any of the stockholders have a right to receive their portion of the dividends. Now, from preferred stocks, you have cumulative and non-cumulative. Cumulative means that if a company chooses not to pay dividends that year, that amount will accumulate, and so the company will have to pay that amount. It goes into what's called dividends in arrears to these preferred stockholders, and it'll start accumulating. So let's say the $4 for this preferred stockholder was not paid in 2015. In 2016, the preferred stockholder has a right to another $4. That's a total of 8. The company must pay this preferred stockholder his $8 before it starts distributing dividends to common stockholders, right? Non-cumulative means that it does not accumulate, and that's not as common. Most people are not going to want to buy a preferred stock if it's non-cumulative, okay? That's the positive about preferred stock, is that you sort of get you get ahead of the line from common stockholders as far as receiving dividends. And if it's cumulative, you almost get a bit of a guarantee that eventually you're going to get your dividends. The negative is that the price of the stock does not fluctuate greatly. So if a company does really, really good, the common stock is going to increase a lot more than the preferred stock. The preferred stock will act like a bond because it has a fixed payment of $4 per $100 in the example that I showed you. So that's not going to change, and so the value of the preferred stock is not going to shoot up. The value of the common stock will shoot up, but the common stockholders last in line as far as dividends go. Okay, so common stockholders get a share. The company does not have to pay them dividends. The company will pay dividends if and when they want to, and that's it. And they're last in line to get as far as getting any liquidation rights if the company liquidates. But the positive thing is, if the company does very, very well, the stock will appreciate a lot because the amount of dividends that they can receive is unlimited, as opposed to preferred stock, which has a stated amount of dividends per share, right? Okay, so I hope that was able to distinguish between preferred and common stock there. So let's start looking at a lot of the examples of transactions here. And a lot of these come straight from the PowerPoint slide, so you could go to the PowerPoint slides and look at them if you like. But I'll discuss them here hopefully make your life a little easier. So the most basic transaction is a company that issues common stock, right? So let's say, and ironically, the most basic one was not in the PowerPoint slides. This is the most common one when it comes to issuing common stock or preferred stock. It's this one down here, and it's not on the slide, so I created it myself. Okay, so let's do this first example first. In this case, the common stock is sold at par, which is something I didn't mention before. So common stock is going to have a par value. It's almost like a face value, right? To a certain degree, it's meaningless. In the past and in some states, there are some laws that require companies to state a par value, because this is the amount of capital that must remain in the company at all times. So this is done to protect common shareholders. In other words, it's done so that the entrepreneur doesn't sell all its shares, receive cash, and then basically funnel the cash out of the company and leave the investors with zero. So there must be a minimum capital in the company, and that's represented by par. But it's lost a lot of significance these days. However, for accounting purposes, it's taken into consideration a lot. So you will have to learn how to deal with par value as far as accounting goes. Okay, so let's assume that this common stock, has no par value. So if it doesn't have a par value, and let's say a company XYZ sold 1 million shares of $1. No, I'm sorry, it's sold at par. It has a par value, but they sell it at par. So they sell 1 million shares of $1 par common stock for $1. So they sold the stock at the value, at the supposed par value of the stock. That very rarely happens. Most of the time, the stocks are sold at much higher than their par value. And par value is simply some sort of, it's just a number that companies come up with. In this case, $1. That's used a lot, and you're going to see it a lot in the examples. So in this case, they sold it at par. So you have cash of 1 million because the company sold 1 million shares at $1, and common stock of 1 million, right? But down here you have the more common transaction that occurs. Okay? Usually companies don't sell their stock at par. The markets are usually, when they go out into the market, it's because the market wants the stock. And the market will bid the stock price up above the par value most of the time, and that's called sold at a premium. If it's sold below the par value, it's sold at a discount, and that very rarely happens these days. Most of the time it's sold at a premium. So what do you do, and how do you account for a stock when it's sold at a premium from its par? In this case, company XYZ issues 1 million shares, $1 par, for $5. So for 1 million shares for $5, they obtain $5 million in cash, right? The portion that pertains to par will go in common stock. $1 at 1 million shares at $1 will go in common stock. The excess, in this case, $4 per share excess, goes in an account called paid in capital in excess of par common stock, 4 million, okay? So this is the most basic entry that you're going to have when a company issues common stock. Okay, it's the most common and the most basic. So what happens when they issue preferred stock? And it's a very, very similar situation with preferred stock. It's pretty much no different. So assume that Caldwell Company issues 2,000 shares of $50 par. So 2,000 times 50 is going to be 100,000, right? I already know that that's going to go into my preferred stock account. But they sold it at 55, so they had a premium of $5 per share sold. So that's going to be 10,000, right? 5 times 2, $5 above the $50 par is 55, minus 50 is $5. So $5 above the par value is what they sold it. 2,000 shares is going to be 10,000. So they receive 110,000 in cash. The portion that pertains to par goes in preferred stock, Remember, cash is a debit account. It goes in to increase. Shareholders account, equity accounts increase with credit balance. So a preferred stock will increase with a credit to it. That's 100,000. And paid in capital in excess of par preferred stock 10,000. Okay, so that pretty much explains what we see up here and how these accounts evolved, right? This here is simply the earnings of the corporation. The earnings of the corporations that stay in the corporation will roll into this line item down here. Okay, retained earnings. And there's other things to shareholders' equity, but they're beyond the scope of this discussion for this course. Okay. So let's take a look at another scenario. When you see these like these, they pretty much come from the PowerPoint slide, and you could go back and look at them yourselves. In this case, stocks in exchange for assets. Okay, so you're not exchanging it for cash, you're exchanging it for certain assets. Assume that a corporation acquired land with a fair market value that cannot be determined. In exchange, the corporation issued 10,000 shares of $10 par common stock. If the stock has a market price of $12 per share, the transaction is recorded as follows. So what are we going to do to value the land that we purchased, right? If we don't know how much is valued, well, it's very easy, because you have your stock and you know that the market values it at $12 per share, and you gave 10,000 shares, so that land must have a value of $120,000, right? 10,000 shares times 12. So you're going to debit land, which is an asset, for $120,000, which is the total market value of stock that you gave. You're going to do the same thing as far as par goes and as far as premium. The par was 10,000. You gave 10,000 shares. That's 100,000 of common stock, right? And the excess of par was 12 minus 10, $2 per share excess of par, times 10,000 shares is 20,000. And so this portion here is done paid in capital in excess of par common stock. So this is very similar to that first entry that I showed you over here, right? Was it this one? This one, right? Very similar to this one. The only exception is that you received land instead of cash. That's all. And another point that that's very important to understand from this concept is that when the asset that you receive, usually you're going to use the market value of the stock because it's the more reliable of the two values. So 9 out of 10 times you will use the market value of the stock. You're going to use the most reliable value source that you have. If you don't know the value of the asset, then obviously you have to use the market value of your stock. If you have more or less an idea of the value of the asset, but the value of the stock is, it's a highly liquid stock exchanged in the market, then that value is far more reliable, and you will use the more reliable one, which is the stock value, right? The market value of the stock. Okay, so here we have another concept involving par. In this case, we're talking about a stock that is issued with no par. So it has no value of par. So in this case, let's take a look at the example. Assume that on January 9, a corporation issues 10,000 shares of no par common stock at 40. And on June 27, the corporation issues an additional 1,000 shares at 36. What are the entries to record this? Well, if you look at this here, it's 1,000 shares sold here and 10,000 shares sold here, and they're sold at different prices. But since this is a no par stock, we are not going to have any paid in capital in excess of par. We simply, in the first case, 10,000 times 40 is 400,000. That's what the company will receive in cash, and they will credit the common stock account for the 400,000. There will be no paid in capital in excess of par for this type of transaction. Same here. Even though the amount was different, $4 less, we are not going to have any paid in capital in excess. We simply book the $36,000 cash and common stock for $36,000. Now on occasion, some no par stock have what they call a stated value. So when they have a stated value, then we will use that stated value just as if it was a par value. Okay? So I'm not sure if they use the same example. If I'm using the same example as up here, let me just put them here, see if it's true, if we use the same one. Assume that Anjay Corporation issues 10,000 shares of no par common stock at 40. On June 27, the corporation issues an additional 1,000 shares at 36. So it's pretty much the same example, except that the no par common stock has an assigned stated value of $25. So some states sort of force the companies that are incorporated in that state, if they issue no par common stock, to assign it a stated value. So in this case, the stated value becomes the par value, and you treat it like the par value. In this case, it's 25, so 10,000 shares sold at 25 is 250,000. That's what you put under common stock. Anything above that becomes paid in capital in excess of stated value. So as you can see here, we're not going to put paid in capital in excess of par. We put paid in capital in excess of stated value. $40 times 25 is 15, times 10,000 is 150,000, and the company receives 400,000 in cash. And you're going to do something very similar with the 36. We know that the stated value is 25, so we'll use that as our par. 1,000 shares were sold times 25 is 25,000. And then the excess, which is $11 per share over par at 1,000, will be paid in capital in excess of stated value is 11,000, and total cash received is 36,000. Okay, so those are pretty much all the journalizing entries that are related to the issuance of stock, whether it's preferred, common, with par and without par, if we exchange it with cash for cash, or if we exchange it for an asset. Let's talk a little bit about dividends, right? We have two types of dividends, cash dividends and stock dividends. Let me explain cash dividends first. When a company declares a cash dividend, the company will have 3 dates that you should be familiarized. The declaration date, right? That's the date that the company declares its cash dividends. So on that date, you want to go ahead and journalize whatever the company is going to pay, because as of that date, they're not fully obligated, but pretty much you know that they're going to enter that obligation of paying dividends, right? So on the declaration date, you would do something like this: cash dividends, and then cash dividends payable, right? The date of record simply states who's going to get paid. And that's the person that owns the stock on that date will be the individual being paid the dividend. And usually the dates go, well, they always go in this order, right? This is the first date, this is the second, and this is the last. It's the date of payment. The date of record has no journalizing entry associated with it. It simply establishes who's going to get paid. Okay? And the date of payment is the day you pay, and then of course you're going to close your dividends payable, and you're going to pay the cash out, right? So let's take a look at this example. Assume that on October 1, Haber Corporation declares the following cash dividends with a date of record of November 10 and a date of payment of December 2. Okay. So on October 1, which is the date of declaration, they are going to enter this entry. As you can see here, it's a combination of preferred stock and common stock. So they're going to do this entry of cash dividends right here, 42,500, which they declared, and cash dividends payable 42,500. Okay. And in the previous examples, we spoke a lot. This account used to be called dividends only. And if you recall from chapter 1, I told you how this is just a temporary account that closes out to retained earnings. there's many books that don't explain it this way. Rather than debit cash dividends, they go ahead and they tell you to debit retained earnings directly. Okay, in this book they teach us to put it in an account called cash dividends, and then later on you will see that it's closed to retained earnings. So at the end of the day, the debit is going to end up in retained earnings, which means that retained earnings goes down, right? Because retained earnings is a capital account with a credit balance, and if you put a debit, it will go down, right? So what does that mean? That means that dividends are paid out of a company's retained earnings. Okay. So on November 10, there's no entry to be made. There's simply going to be a record to say who we pay the dividends, and that's going to be as of the holders of stock on that day. And on December 2, the cash dividend is paid, and so you paid out your cash. You close your cash dividends payable, right? Here you put a credit, here you put a debit, so it has a zero. You pay out the cash. So now you have this cash dividends of $42,500 sticking out like a sore thumb, because it's not an account that should be in our final books. So what do? We simply close it with retained earnings, as I told you. We take it out of here, $42,500, and we put it where theoretically it truly belongs, which is retained earnings. Now, the way the book explains it, to put it here, it's sort of good, because now you have one account where you have all your cash dividends accumulated, and it's a lot easier to analyze. And if you're going to prepare a statement of retained earning, a statement of stockholder equities, then you're going to know. You know that a statement of retained earnings, you know exactly what cash dividends were paid, and it's a lot easier when you have it separated, and that's why the book shows it that way. Many books don't show it that way. They just tell you to debit retained earnings from the beginning, and so this step is skipped. But it does have its merits to put it in cash dividends first. As an analyst, as a past analyst, I'll tell you that it's nice to have these type of things in their own accounts. But then you have to remember to close it and put it in retained earnings, because that's where it really belongs. It's a reduction of retained earnings. Again, dividends are paid out of retained earnings. Okay?
So let's explain now the concept dividend in arrears. And I already gave you a bit of an overview of this when I spoke about preferred stocks. I told you that we had that there existed two types of preferred stocks, one that was cumulative and one that was non-cumulative. So in a cumulative preferred stock, when the company does not pay dividends for 1 year to those preferred stockholders, those dividends accumulate. In other words, the company is obligated to pay those dividends in the future, and they must pay the preferred stockholders dividends first before they can pay the common shareholders, right? So, and I pretty much gave the same explanation up front in the video as we started it. So let's take a look at this example, and it says, assume that a corporation has issued 1,000 shares of cumulative preferred $4 stock, which has a $50 par value, and 4,000 shares of common stock, $15 par value. So here we have $4 stock, preferred stock at $50 par. It's expressed in dollars. It could also be expressed in percentages, right? So what a percentage would this be? Well, this would be 8%. 4 divided by 50 is 8%, right? So, so what is, okay, so it says the corporation was organized on January 1, 2014 and paid no dividends in 2014, right? So that means that the $4 for every preferred stock is accumulating. You have 1,000 shares, so you have $4,000 that has accumulated. In other words, they're in arrears. That's what we call dividends in arrears for preferred stockholders, right? And it said it paid no dividends in 2015. Now we have $8,000 in dividends in arrears. You must pay that $8,000 to the preferred shareholders before you can pay the common shareholders. in 2016, the corporation paid $22,000 in dividends. So it didn't pay $4,000 to the preferred shareholders in 2014. It did not pay $4,000 to the preferred shareholders in 2015. In 2016, it finally pays, but that year, the preferred shareholders also have a right to another $4,000. So in total, they have a right to $12,000 before the common shareholder can be paid. Okay? So here they give us the answer, and I'll explain it a little bit more, of which $12,000 was paid to preferred stockholders, right? As I explained, $4,000 for 2014, $4,000 for 2015, and $4,000 for 2016. And $10,000 was left for common stockholders. So here they have a chart. We have a chart here. Total dividends paid in 2016 was $22,000. As we had stated before, 2014 had dividends in arrears of $4,000 for the preferred stockholders. 2015 had dividends in arrears of $4,000 for the preferred stockholders, and 2016, well, that was what the preferred stockholders had a right to for that year, for a total of $12,000. So they get their $12,000, and the common shareholders get $10,000. Okay. So in this example, the common shareholders get less than the preferred shareholders because there was a lot of accumulation here. But, there's going to be years, as this number goes up, the amount of preferred dividends that the preferred stockholders get is limited, but the amount that the common stockholders get is unlimited. So that's why the common stock will appreciate in value much more than a preferred stock does when the company improves its financials, right? And its outlook is improved. Okay, so for the final concept related to shareholder equity and dividends, let's talk a little bit about stock dividends. Okay, stock dividends are normally given out to common shareholders. And I'll let you know up front that stock dividends does not create any additional value for the shareholder or the company. It simply divides the company into smaller pieces, and that's it. You're not going to be richer if you own shares. You're simply going to have more shares of less value. So let me give you a small example. Let's say a company is worth $1 million, right? 1, 2, 3. Okay, so the company is worth 1 million. Hopefully I did this million right. Let me put the commas in there. And it has 100 shares outstanding. So each share is going to be worth $10,000, right? So this company says, well, $10,000, that's a lot of money to pay for one share of stock. And if we lower it, well, maybe more people will be willing to buy the shares. So how can we lower the price without really affecting any of the economics of our company? Well, let's say they do a 50% stock dividend, right? So 50% of 100 is 150. So now they have 150 shares. But is the stock going to be worth $10,000? No. It's going to be worth, each stock will be worth now $6,667. So what it does, so the company's value is still going to be the same, right? And whatever you hold is still going to be the same, right? So if you held 2 shares at well, let me finish with this thought first. So the company 667 times 150 is worth the same that it was before, right? And your value is going to be the same. If you held 2 shares at this point, now you're going to get a 50% stock dividend. Now you're going to own 3 shares, right? 2 shares at $10,000 is $20,000. 3 shares at at this amount is going to be $20,000, the exact same amount. So you're not going to be any richer, except that you're going to own more shares. And so that's done a lot by companies to increase the amount of shares outstanding, many times simply because that way they can lower the individual value of the shares. And in doing so, maybe they make each individual stock more accessible to each individual shareholders. You know, these days we have companies with stocks that are in the hundreds and hundreds, like Google and Amazon, and so maybe they want to do a stock dividend just to lower the price, so that a person that wants to buy stocks for $100 or maybe $50 can buy it. Okay. So that's all that is that a company does when they do stock dividends. And before explaining each individual transaction, because it's a little bit more convoluted, let's explain the concept behind what accounting for stock dividends is trying to accomplish, right? So I'll go all the way to the bottom because that's the easiest one of all to explain the general concept. Here's the general concept, and here's the overall effect that we're going to end up with in the accounting books. Okay, so let's say a company declares a stock dividend where the stocks are worth 3.1 million. Okay, so in a sense, the way you want to look at it is as if the company used their own money taken from retained earnings. So now retained earnings is going to go down, and they're going to buy their own stock and give it out to the shareholders. So what are you doing with the company? You're simply shifting from retained earnings and putting it into common stock and paid-in capital. That's all you're doing. It's a very simple transaction. Retained earnings, all equity accounts have credit balances. So here retained earnings goes down by 3.1 million and common stock goes up by 2 million, which is the par value of the common stock, and 1.1 million, which is the excess. So in essence, just picture the company buying 3.1 million from their own treasury stock and giving it out. They buy it with money from their retained earnings, and when they give it out to the shareholders, now all of a sudden you're going to have this amount outstanding for the shareholders. Okay, in common stock and paid-in capital excess of par. So let's take a better look at the example. This is good to understand the concept before we do the example, okay? So let's take a look at the example. On December 15, Hendrix Corporation declared a stock dividend of 5%, or 100,000 shares, right? So we're talking about this data here. 2 million times 5% is going to be 100,000. So they're going to give out 100,000 shares to be issued on January 10 to stockholders of record on December 31, right? So this is the declaration date here, January 10. This is the that's the date of record. Excuse me, and the market price of the stock on December 15 was $31 per share. So that's going to tell you how you're going to value that stock, $31 per share. Okay, and that gives you an idea of how we got that 3.1 million that we saw on the bottom when I gave you the first explanation, right? So $31 per share times 100, that means that the total value that you're going to give out in stock dividend form is going to be 3.1 million, right? So we're going to put it, this is the entry that you do when you when the company declares the stock dividend, right, on December 15. I think I got these dates wrong. This is the declaration date, December 15. This is to be issued on January 10. This is the date of payment, January 10. And December 31 is the date of record, okay? I had said it wrong before because I didn't realize that. I didn't see the December 15 here. Anyway, so on December 15, the date of declaration, we're going to do this entry. We're going to put this in stock dividends. Now, in essence, what we're doing is we're lowering retained earnings because this stock dividends account will be closed to retained earnings. So in many books, I can't recall if I mentioned this before, but in many books, they don't use the stock dividends account. They simply put retained earnings, and they tell you to lower retained earnings. So you want to lower retained earnings. We're going to put it in stock dividends for now, to keep it separate for now. As per the book, and this helps you track the transactions a little bit better in the equity accounts. So if you want to know, well, how much I gave out in stock dividends, you could go straight to that GL. But this is going to eventually be closed before the year end to retained earnings. So in essence, you're going to take the money out of retained earnings and you're going to give it to your shareholders in the form of stock. So you're going to put it again in an account that will be closed eventually. Stock dividends distributable, that'll become common stock. And paid in capital excess of par, common stock 1.1. This one stays. This one they put as is. Okay? So if you look at this December 15th transaction, that's what you do. This is eventually what that will become. Okay? Retain. Let me see if I can put them closer together. Yes. This is okay. So this stock dividends eventually is going to be closed. Really what we want to do is lower retained earnings, and stock dividends distributable will be closed, and what we want to do is increase common stocks. Okay, but these are temporary accounts where we put them for the moment. Okay, so on December 31, let's recall that that this stock dividends account really doesn't exist, and it should not be in your final balance sheet. So you will go ahead and you're going to close the stock dividends to retained earnings. Okay, so retained earnings is really what went down. You took your money from retained earnings to buy stock to give it to your stockholders. Retained earnings goes down by 3.1 million, and you close the stock dividends account. Now the stock dividends account has a zero balance, right? Had a debit here and a credit here, so the GL closes at zero, and retained earnings decrease by 3.1 million. On the day of payment, January 10, the stock, and you have to keep in mind that I'm assuming that this is the end of fiscal year, because that's when you do these closing entries, end of fiscal year. This is like a closing entry. On January 10, the stock dividend is distributed to stockholders by issuing 100,000 shares of common stock. The issuance of the stock is recorded by the following entry, okay? So all you're going to do is close what I had told you was going to be a temporary account, stock dividends distributable, which we had up here, right? You're going to close it. Now it's going to be zero, and you're going to put it in the proper account, common stock. Because now you're actually going to have the common stock out there circulating, right? And that's it. And at the end of the day, what are you going to end up with? Well, with what I told you at the end. At the end of the day, you're going to have your retained earnings decrease by 3.1 million. That's the cash that you use to buy your own treasury stock. And that's stock that you already have in the company. You don't have to go out in the market and buy it as a company. You have it. So you take it out of your treasury stock and you supposedly buy it. I mean, this is just theoretical to help you try to understand what they're doing. So you supposedly buy that stock according to my theoretical example. And then so you use retained earnings to buy it. So retained earnings goes down by 3.1 million. Now you have 3.1 million worth of stock, right? And you give it to your shareholders in the form of a stock dividend. And so now you have 3.1 million worth of stock circulating. That equates to 2 million par value and 1.1 million excess par. Okay, so this was the last example, and for the videos talking about stockholders' equity and dividends. Okay, thanks.